strong. I'm not gonna have a spaghetti to know. Yeah, I'm strong.
Your audio is on.
Hello, good evening, everyone. Can anybody hear me?
Yeah, we can hear you.
Oh, okay, great. Please just give us another 1 to 2 minutes to start. So I think it's just 1 minute to 5, and hopefully by 5:01 on the dot, we should be able to start. Yeah, thank you. Okay, I think we can start now. I'm just going to turn on my video now. Just a second. I hope you can see me.
Yeah.
Okay, good evening, everyone. Please kindly mute your mic as you join in, please. Please try to mute your mic. Thank you. Yeah. So good evening, good morning, good afternoon, everyone, depending on where you are joining from. My name is Taiwo, and I have the privilege of hosting this particular webinar today. So I want to say thank you to each and every one of you for being here with us today. We are pleased to be able to welcome our alumni. I believe there are members of our alumni on the call, on this call, as well as those who are new to our community. I also want to convey my my heartfelt gratitude to Victor Ogundele. Please kindly mute your mic, please. Mute your mic. Thank you. Thank you. Thank you. Okay, so please mute your mic and join in, please. All right. So I said that I want to really appreciate Victor Ogundele on behalf of Scenario Academy. I want to appreciate you for accepting the invitation to facilitate this webinar on financial statement restructuring in corporate finance. Without wasting too much of the time, I will quickly jump into what I have for today. Please, can you just mute your mic, please, as you join? please mute your mic. Thank you. All right. So the first thing I'm going to do here is to read out the agenda of today. Quickly, the first thing we are going to do is to read out the housekeeping rules. Afterwards, we'll do introduction of the faculty, that's Scenario Academy faculty and the scorecard. We would also introduce this guest facilitator in the name of Victor Ogundele. Afterwards, we then move into the presentation proper, and then we will take have a Q&A session where we take questions. I'm sure there'll be a lot of questions for Victor. Then also afterwards, we'll then have a session with you on leveraging industry expert experience as far as financial modeling, data analytics is concerned. Then we'll take any question you may have for Scenario Academy and close out this session. So once again, it's a pleasure to welcome you once again to this event. The first item here is the housekeeping rule. So I would just like to read it out. Please try to mute your mic at all times. There are times whereby you think that your mic is on mute, but you would, without knowing, that is not. Hello, I hope you can hear me.
Yeah, we can.
Yes, we can.
Okay. Okay, great. So the second thing here is also for you to ensure that you use the chat box in case you have any question to ask while the presentation is going on. You can always start your question. If it's a question, you can always start it with a Q. But if it's a comment, you can just drop the comment there. It's also important to encourage the emoji or whatever it is, and even if it's getting boring, you can always put like a eyes emoji so the facilitator can know whether to pivot. I'll plead with you to try and remain present in this webinar, even though the recordings will be made available to you at the end of the day, but try as much as possible to remain present. And should you have any question you want to ask, you can always use the hand raising icon or the hand raising button. So the next thing I'm going to do here is to quickly tell you a bit about Scenario Academy in the next 2 to 3 minutes. So Scenario Academy is I can call it an expert-led community. So we actually started as a community that later morphed into an academy. And what we do now is that we help people, we help enterprise to transform their, we help to transform as far as data analytics and financial modeling is concerned. We also basically, take in individuals who are interested in improving their data and business and either power continual performance within their current role wherever they work, or it could be it could be that they want to completely transition into data analytics from their current role. And what we do is to help them really get started properly. And at the end of the day, the goal is basically to contribute to developing a great workforce. Just to actually be able to meet up with the demand that is required for the future of work. What is the future of work? As you can see, future of work is basically shaped by two powerful forces, and one of the most important of those two forces is the growing adoption of data analytics and artificial intelligence in the workplace. So the work of the future is gradually, looking to tend towards the adoption of artificial intelligence and analytics. It's important to better position yourself right now. So what are our competitive advantage? One of the things we did to actually stand out amongst others is that we decided to introduce what we call a data-driven decision-making session within our deliverables, our program deliverables. And we also offer a 3-month post-training internship after training, training with us. We also create a community from our participants, whereby we bring them, our alumni, together to have them meet up with industry experts on a quarterly basis who can share ideas, within our faculty. And we have a combined, and our faculty members actually work across several enterprises, from healthcare to FMCG to airlines to financial institutions. So that being said, I'll just quickly move on to the next thing. This is just a brief of our scorecard. We were founded in 2019. We've trained over 530 people so far. Half year 2021, we were able to train over 100 people. And currently at the moment, because we take a 3-month internship for those who are interested amongst our participants, and we currently have about 14 of them within our internship academy at the moment. So looking at our scorecard, it's quite interesting to know that we almost 34% of our participants actually came from the financial institutions. So it's quite an interesting aspect of us, and which is one of the reasons why we are trying to offer a program like this that will really be of importance to people within the financial industry and beyond. So as you can see here, we have participants across several countries, and we've been able to train a couple of employees from some corporate organizations, as well as individuals and participants from different top organizations. So that being said, that takes us to what we have for today, which is why we are here. So why are we here? So we found it important, or we realized that there is actually a need to do a deep dive into, because financial modeling and business valuation seems to be a big thing now. And we realized that one of the ways of giving back as a form of CSR is to organize a program around financial modeling and business valuation. So today we are going to look into, or take a deep dive into, financial statement restructuring in corporate finance modeling. So, a couple of questions that have been asked is, why do we need to restructure financial statement before modeling? What impact does it have on generating insight? Of business partners. So we realized that the only one of the is Victor Ogundele. And who is Victor Ogundele? Victor Ogundele is a financial modeler and financial analyst, as well as a corporate trainer. He currently works at David Brown Consulting, which is popularly known as D Brown Consulting. There's a reason why I'm smiling, because every time I try to read, when I was putting together this particular slide, I was just smiling all through. Like, this is, I was just so excited about what Victor has been able to achieve within a short period. He has over 13 licenses and certifications, around financial modeling and business valuation. And he's FMI certified, that's the Financial Modeling Institute. He's FMVA certified and WallStreetMojo certified, as well as IBCS certified. IBCS is the International Business Communication Standard. And currently at the moment, Victor works as a financial model, like I mentioned earlier, at Brown Consulting. Victor started his career as a financial accountant at Grand Valley Hotel. He later moved on to become, to join Sam and Wright Consulting as a financial modeling and modeler and analyst. He, after then moved on to join BPI Advisory as an associate financial advisor. He currently works right now with Brown Consulting, which he joined in January 2020. Within that period, he took some time to intern at JP Morgan and KPMG just to hone his skills in commercial banking and data analytics. Victor is an alumnus of Obafemi Awolowo University, where he studied accounting. Great Ife, I guess. Victor also went ahead to study financial management at the International Business Management Institute. Now, this is the interesting part. Victor has worked on over 150 financial modeling projects across industries globally and trained over 1,000 top executive personnel on financial modeling. That is impressive. It would also interest you to know that Victor, was a top 16 Excel user, competition, which was organized by the Financial Modeling World Cup and Association or body. Now, here's the interesting part of it. Victor at the moment is currently representing Nigeria in the current Global Financial Modeling World Cup competition. And he's currently ranked 5th in Africa. That is a hell of a profile. So before I hand you over to Victor now, I just have one question for you, Victor. Are you there? Victor?
Yes, I'm with you.
Okay, so I'm fine. So Victor, quick one. So if you are not designing or developing a model, or you're not training a class, or you're not participating in a competition, where else would we have, would we be able to find you on a Saturday? Is it evening or afternoon like this? Then once you answer that question, you can take over.
All right, so thank you so much. Right, I think I'm really shocked when I saying this, right? Okay, let me switch to my video before I will switch that off. So hi everyone. Yes, this is Victor. Yes, this is I just can't believe this is the profile I'm actually seeing here, right? So a big thanks to our sponsor, Scenario Academy. Yes, serious thing about me is this. Should I say serious thing, or the truth about me is I'm really not that serious kind of person. Yes, I'm a very jovial person, and if I'm not building model, I'm not doing anything. I like traveling. Yes, going to new places. If not for this, I think I ought to be outside where I am currently, just trying to know new places. So yes, that's what I usually do most times. I like traveling, knowing new places, some research. Yes. All right. So without wasting our time, this introduction just kind of overwhelmed me. So please kindly grant me permission to share my screen so that we can just get straight into what we'll be discussing today. Okay, all right, so let me just try and share my screen with us. Yes, okay. So that we'll be able to focus, let me just switch off my video for now. Great. Well, a big thanks to Scenario Academy for giving us this platform to be able to share our knowledge together. Trust me, what we are going to do today is not as if it's one-man knowledge. You know everything. No. It really does not work like that. So majorly that's what we'll be doing today. So let's take a look at our major learning points. We're going to take a look at what we call structure of income statements. I know we have accountants in the house. I'm also an accountant. So one thing I've noticed is this. Most people really don't understand what income statement is saying. Yes, some of us call it profit or loss account. Some of us call it profit and loss account, while some of us call it statement of comprehensive income. But for this, at least let's just agree with one name today. Let's call it income statement, everything being equal. So we take a look at this and how you need to understand it. Then from you having that understanding, there's now this link between an accountant, we call it an accountant income statement. It's really not an accountant, but it's what we call a standard, right? So currently, in the country where I am now, we have something we call IFRS that kind of govern, oh, if you are doing your reporting, you should follow this format. GAAP also saying, oh, you are building your financial statements, you should follow this same structure. Then how do we now link that to what we call a structure of an analyst? Some call it analyst-based income statement structure. Some also call it driver-based income statement. And that is what we are going to take a look at today. And then modeling and drivers, which is kind of one of the reasons behind we restructuring. And then we take a look at a case study, a sample case. Yes. So let's get straight into this. A structure of an income statement, also known as profit or loss account, right? But I said for the purpose of this presentation, let's call it structure of income statement. At times, it's not all about you knowing something, right? It's about you knowing what is this thing even saying. Okay, so please, my coordinator, please, is it possible for us to help us stop people from drawing? Yes, people are trying to draw. So we just stop them so that they can, okay, all right, great. So now let's take a look at what we call structure of an income statement. Irrespective of the type of business you do. Number one is you need to understand that every business, they all have what we call business cycle. We have what we call business cycle and accounting cycle. Business cycle is saying, oh, what is the asset that you have in your business? How well are you using these assets to generate more revenue? And how well are you converting your revenue into profits, then profit into cash? Then for the accounting cycle, they are just telling us, how have we been able to record this business cycle? Now, irrespective of the business you are doing, even NGO business, they still have what we call income, which means revenue is very important to every business. And as an analyst, as a modeler, even if you don't understand much about a business, you need to understand how they are generating revenue because it's a driver. When it comes to business valuation, there are a lot of sensitivity that we build around revenue. For example, it's most especially startup. One of the staff can leave the business and it will affect the business performance. Long story about that, but we are not going there today. Revenue is like the umbrella of the business and everyone is eating from the revenue. That's the whole thing. Because once anything happens to any business revenue, you know what? Automatically the business is going down. Let's take a look at last year. Let's take a look at what we had last year during this pandemic period. Many mature firms, they were unable to cope. In fact, so many businesses had to file for bankruptcy, right? Yes, there are a lot of other reasons behind that, right? But most of them were able to sustain because there was no income. Now, revenue is like the umbrella of the business. And everyone is eating from the revenue. The first people that eat from this revenue are people that have contributed directly in way generating our revenue, which means if we don't incur these expenses on these guys, on these things, we might not be able to get our product out to the market, talk less of we selling it. An example for a manufacturing firm, if you don't buy that raw material, definitely there's nothing you're going to process to have your final product, talk less of selling it. Those guys that you pay that take your products from your store out to the market, if you don't pay them, there's no way your business, right? Your product can get to the market, talk less of you selling and making that revenue. Those are the first people. On the other side, yes, when it comes to management accounting, we call it variable cost. So which kind of move alongside with your revenue. Then we deduct that and we have what we call gross profits. Now, most times when we do analysis, we always measure almost all line item against revenue. There's this school of thought that is saying, fine, that's cost of sales, right? Also cost of goods sold or direct costs or production costs, irrespective of the name you give it. Now saying, okay, if we've actually deducted that, then this guy called gross profit is, some call it, our management account, we call it contribution. Then we should be able to kind of measure everything against your gross profits. There are really a lot of story that can tell us. So, sorry, we are really not going there today. Now, after the gross profit, what we have from this gross profit is what every other person in the business, every other person supporting the business, they will eat. So you need to understand when they mention these expenses, it's not about you just saying, oh, this is where it will go. You need to understand how is it affecting our business performance. Now, SG&A, selling general and admin expenses, also known as our operational expenses, some call it our fixed cost, comes into play, which is the first person that eats from this contribution. So we are saying, oh, this business, this is the revenue, these are the costs that such that if you don't incur this cost, there's no way we can make this revenue. Fine, we have no control over that. Then this is what we have left now. Then how well can we manage this gross profit to give us our profit for the period? We deduct this, and we accountants, we have something we call earnings before interest and tax. In fact, the same thing as our operating profits. Now you can see how they are all eating from the revenue, because revenue is the umbrella. Our finance cost now comes into play, more like our net finance cost, your finance income and your finance expense. Then we have our earnings before tax. Government comes into play. They eat their own from the business revenue. And what we have left is profits after tax. Now, just take a look at the size of all those expenses to revenue. So now imagine this revenue, which is like the umbrella, is not as high as this. What do you think will happen? Automatically, the business has no profits to make. Then what do you have left? Dividends, which is owners eating from the business. And what we have left goes straight to the business. Oh, let's retain this to increase our company, the owner's stake in the business, right? So your revenue down to your gross profit is what we call top line. During my years of experience when I'm teaching corporate guys, and the one question usually pops up like, wait, those top executive guys, why are they paying them that much? Right? The reality of it is this. What they do, they are more like the backbone of the business, because they are the one making that decision. Yes, it might not be so glanced to you. They're saying, oh, how do we increase our revenue? What are the things that we can do? What other strategy can we work on? How can we manage our cost of goods sold, right? Such that we have this gross profit, the same thing as our contribution margin, such that is very large to absorb every other cost that we have below it. That's their own work. So companies, they are always more concerned about this top line. Yes, and they are ready to go to any extent to be able to do what? To have people that are capable to undo this, because that's the whole thing. Because anything happen to your revenue, your business is gone. And if your cost is way too high, then you are really not, you are not doing any business. You are really not doing any business. And what we have below that, is what we now call bottom line. Now, We're going to have a case study. And so for some of us that are joining outside the country, I'm quite sure you would have heard about this, our wonderful company. So we'll be working with a company called Dangote Cement. Yes, it's a company in Nigeria. It's one of the leading firm when it comes to business as a whole, and they have this good management, trust me. So let's take a look at how their financial statement is. So let me kind of go to, I think that should be page 159. So now let's just kind of measure this to the visual that I just gave us, which is this: revenue, cost of sales, gross profit, SG&A, EBIT, finance, EBIT, tax, and profit after tax. Taking a look at this, now, this is the structure as given by our standard, our accounting standard. So it depends on the one they use in your country. They're saying, oh, whenever you are creating your own financial reports, make sure it follows this format. Your country, the same standard. So when you have anything like standard is just trying to uniform how we do things. That, oh, if you are doing it like this in your own place, I should be able to do it like this in my own place. Now, let's take a look at this. We have our revenue, production, cost of sales, gross profit. Using that visual that I gave us, just take a look. Let me try and zoom this out for us. Take a look at their gross profit, 2020 and 2019. Based on this my visual. Now, you should be able to understand income statement and ask, what is this saying? When I'm saying gross profits, what is it saying? Right? So you don't just say, oh, the gross profit is a 20-something percentage. What does that mean? Does this show that, yes, this company is well managed? How efficient are they using their costs? Are they managing their costs? If you look at previous year, you look at their cost of sales, margin. How well, for a mature company, you expect to have a trend. What is the brain behind that? Admin, selling and general, which we call SG&A, other income, impairment of financial assets. Now, I'm quite sure you have seen some line item that did not appear in my own, right? Profits from operating activity, which is the same thing as our EBIT. Finance income, finance cost, share of profit from associates, profit before tax, income tax, and profit for the year. So let's leave that. Every other thing you have below that, they're just telling us how they've shared this same profit for the year. You've seen this visual. Good. Now, let's analyze. A number does not make sense on its own. Now, what you are doing now is we call it ratio analysis without number. So even if you don't understand finance, you should be able to see that, oh, revenue, you're saying, oh, this is what is eating from this guy. Gross profit, this guy is eating like this. This portion is eating, this portion is eating, until you have what's this. Now, this really does not make sense, right? You agree with me. The next question is, how do we analyze? So let's even analyze with this income statement. And what I've done is this. I selected another company, which is very good and great company, Nestle Nigeria PLC. And what I've done is this. I took their financial statements. Revenue being constant. I tried to see how well they change over the period for a mature company. Right? You know, our business have different stages. So for a company that has gotten to maturity stage, there's this expectation of high level of consistent trend. Now, when we take a look at the trend of a company and we see that something kind of change in that trend, it calls our attention to something. We're asking, oh, is it that something happened in the economy that affect this business? For example, pandemic last year. Or, oh, is it that something happened with this management, or something happened in the market or in the industry? That kind of allow us to understand, okay, going forward, how risky is it for us to invest in this business? What are these? What are that? It's kind of help us to ask different questions. Now, let's take a look at Nestle 2016. Yeah, this is a billion. So don't worry, you're not seeing numbers. I call it ratio analysis without number. This is their revenue. So 2016, 2015, their revenue grew by 20.3%. Right? Their gross profits to their revenue, you can see the shape. EBITDA, yes, I know we've yet to mention something called EBITDA, but look at the EBITDA. look at the EBIT. So I selected their revenue and I measure it against their profitability line. And then we have a profit before tax and we have profit after tax. Now, the next question is, what do you think they would have done better to be able to increase this profit after tax? Because that's what the owners are really getting, right? Affect the share price and all those things. This profit after tax is way small. Now, this really does not make sense, even though you can still be able to measure the shape. Now, let's check this against another period, which is 2017. Now, take a look at my simulation. Yes. So in 2017, their revenue increased significantly, 34.2%. The next question is, what happened in Nigeria in 2017? What happened around that for them to just have that kind of growth? Yes, you can always do your research on your own. The good thing about it, let me show us again. This is what they had in 2016. In 2017, look at what happened. Yes, revenue increased, but they tried to do what? Adjust their gross profit, their cost of sales, cost of production. So for some of us that did economics, we know this is what we call opportunity of scale, right? There are some expenses that can be fixed for some time, then over a period, it turns to be variable. There's some expenses that can be variable over the time, it turns to fixed, right? So the manager just tries to make sure that let's manage this thing, right? Revenue cannot be increasing and cost too. So there's a way to manage it. And this is what you can see here. Gross profit, let me show us again. This is 2016. We said revenue being equal. How well were they able to adjust themselves? Gross profit, they were able to adjust themselves. EBITDA, EBIT, profit before tax, and you can see profit after tax increased. In 2018, something else happened again. Revenue was able to increase by 9.1%. But you know what? It looks like they make sure they maintain that margin. Then in 2019, what happened? Then in 2019, revenue increased by 6.7%. But you see what? They try to maintain this margin. And that's what they call a good management, a good company. If you want to forecast this kind of company, definitely it will be easy for you because you can see what we call consistency. Revenue increase, they try to keep that margin. Hey, you cannot spend more than this. Hey, we must try to maintain this. And if you look at 2020, even despite pandemic, yes, revenue growth was a little bit smaller, 1.1, but you know what? They still try to maintain that margin. And that's a good way for you to understand what we call income statements. Somebody does, oh, revenue this, revenue that. Now, that will now take us to the next thing. The next question is, why do you think we even build financial model? So yes, I've been talking since. Let me hear from us. Just type in the chat box. Number one, why do you think we build financial model? What is the importance of this financial model, at least to corporate firm? So you can just type in the chat box. Why do you think we build model? What's the importance, especially to corporate guys? Why do you think we build model? To value a company, I agree with you 100%. In planning, capital raising, forecast the future profit of a firm. Yes. Projects, lot of reason. Business performance, I love that. To give idea on how a company performance will be. I agree with you. Thank you for that. Now let's take a step back. Let's assume, let me take two companies, Nestle and Unilever. That's a very good example. At least they are close to each other. Let us assume we want to build a model. Let's say maybe for decision making, right? Or strategic decision making, or just for us to know that, okay, which firm do you think will stand better in the next coming 5 years? And we take Unilever, we take Nestle. Now there's something we call common size financial statements. Common size. So which means that is saying whenever you want to compare one or two companies together, you need to bring both of them to this common size, to the same size. B1. So which means if you want to do a value, if you want to compare one business performance to another, we need to bring both of them to a very clean and clear line. So we are saying we are comparing A to A, B to B. On the other side, let's even assume we want to go ahead and value a company. There's this line item in our profit or loss account. So I'll try and give us a little clue. The line item is actually a metric to we finance guys, because in fact, to me, in fact, if you give me this line item and you did not give me the business revenue, I can still go ahead and value the company. Right? Now, let me ask you. That line item is very important. The line item alone is enough as a value of a company. But currently now, if you take a look at this, our profit or loss account structure as given by our standard, the line item cannot be found in this, our structure. Now, let me ask you, what do you think that line item, what do you think we call the line item? What is that name of that line item? It's like a line item, yes, usually have it in our profit or loss account, but taking a look at this, currently now, we do not have it there. Okay, all right, great. I know I have my advanced guys in the house. So definitely, it is what we call EBITDA. It's what we call EBITDA. EBITDA is enough to even just, what is the EBITDA? This is the EBITDA value. What is the EBITDA multiple in the industry? Multiply that is enough to give you the company market cap. The next question is this: why is EBITDA important? If EBITDA is so important, why is it that our standard that has given us of income statement structure has really not incorporated EBITDA into it? What is the brain behind that? Now, EBITDA is very important because it's more like a cash made from the business operation. In fact, there's this type of analysis where they say, measure your EBITDA to a company cash flow from operations. Then try to look at the trend. And it kind of tell you a story. If a company is making up line about their income statements. Yes. So we are not going there today. We are not going there today. That's more like a valuation thing. The next question is, if EBITDA is so important, why is it that standard that we are using, right? IFRS, our GAAP, yeah, the one you use in your country, respective country, has really not they've not included it in this structure. And that's the next thing that will now take us into what we call analyst. Some call it analyst-based structure. Some call it driver-based structure, irrespective of the one you call it. What is the reason behind we having this structure? Now, I want us to understand something. Our accounting is great. But most times, I wonder why we usually have this argument. It's really not arguments. I won't say it's arguments, right? But let me even say it's restructure. Accountants, you submit your financials. Tax people will pick it up. They will tell you that, oh no, this cannot be, that cannot be, that cannot be, that cannot be. They will tell you they need to rearrange, and it's more like restructure it to fit what they have. Now, analyst guy too, they will pick it. They will say, oh, this, oh, that, oh, that. The next question is, why are we really having that? That should be the question you are going to answer yourself. I'm really not going to do that. Now, let's take a look at revenue. We want to take a look at what we call what? Just remind us. They call it analyst-based structure or driver-based structure. For we finance guys, right? Finance is very flexible. And on the other side, we deal more with common sense. Yeah, does it make sense? Yeah, right? It can make sense to you and not make sense to me. One of the reasons why finance is very, very flexible. It's not rigid. Finance is not rigid. Now, revenue, I told us, revenue is like the umbrella of a business. And first, just remind us that everyone eats from this revenue. Because if anything happens to revenue, it affects the whole business performance. What gave birth to this restructuring? Number one, I said, why do we build model? Oh, yes, forecast business performance, look into the future, everything. On the other side, we said, I don't want to build a model, I want to compare this business to another business. Definitely, we need to bring both of them to the same line, right? We analysts, we like to gain more insights into business performance. So we need something that can give us and can answer more questions. So first people that eat from this, we said cost of sales, then we have our gross profits. These three guys being put together, they are called top line, because it is what we have left from this that covers every expenses you have. So you must focus be on these three guys. Then we said our selling, general and admin expenses, also known as our operational expenses, comes into play. Then we have our EBITDA. Now, let me take it a step back. So let me relate this to our management accounting. You have your revenue, right? You have your variable cost, which is the same thing as your cost of sales. Then you have what the management guys will call it contribution. Then you have your fixed cost. Then to the management guys, this EBITDA is their own, is the real profit, because this is the core activity of a business operations. This is the core activity, irrespective of the type of business you do. Revenue, constant. Cost of sales, which is your variable cost, you constant. Gross profit, yes, you must have that. SG&A, which is just your selling, general and admin expenses, your operational expenses, your monthly expenses. You have that, then we deduct that, then this is EBITDA. To we finance guys, valuation analysts, this is the real business. This is the real business, and we call it core business operations. So which means if I want to compare Nestle to Unilever, I need to bring both of them to the same size, to the same structure, so that it's easy for me to compare, oh, core business operation of Unilever to Nestle. Now, taking a look at this, our financials, on your, I'm quite sure you are seeing one or two things. No, we are not saying what they've done is not correct. Never. We are not questioning them. But for that comparison's sake, now you can see now that we've not even touched what we call our operating profits. Now, this usually confuses people. Like, okay, we are saying this is the core business operation. Then EBITDA is supposed to be the operating profit. Okay. Now we have our depreciation, amortization comes into play. Yes, impairment also comes into play. And this is what we call the use of the business assets. Now, everything you have below EBITDA, they'll deal more with management decision. Yes, management have decision and control over it. And to we finance guys, we are saying that should not be the basis when we are comparing A to A or A to B. Now, revenue, definitely not management of a thing. You can take your product to the market and the people decide not to buy it, right? This is your cost of sales. Yes, there's really nothing you can do. You need to buy your raw material and all those things. SG&A, these are people supporting your day-to-day business operation. You need to incur that, right? But use of assets, this with management decision. Now, let me give you the example. Let's assume Nestle, the manufacturing firm, right? Let's assume they are doing their production in-house. Now, see the scenario. Nestle, they are doing their own production in-house, which means they have all their plants and equipment in-house. So let's everything being equal. And let's say Unilever, they are outsourcing their own production, which kind of results to them having less equipment. Now, let me ask you, which of the two do you think we have more depreciation? So let me recite my scenario. Nestle, let's assume they are doing their own production in-house, right? They have all their plant equipment in-house. Then Unilever, they are outsourcing their own production. So they just have small plants. I'm not asking, which of them will have more depreciation? You agree with me that it's Nestle? Yes, I know we have some other, if you take it, if you go deep into it, yes, benefit and all those, but let's just put it on a like to like. Definitely Nestle. But the next question is this. It is Nestle decision. It is Unilever decision to adopt that system. That should not be a basis whenever I want to compare them. On the other side, yes, depreciation and amortization, they are really not a cash of a thing. They are kind of provisions. So as if you take your money, oh, I'm taking 2 million, I'm paying it for my depreciation. No. Yes, maintaining of those assets, those would have come inside your SG&A. So we are saying these are management decisions. It should not be the basis when we are doing comparison of like to like. Now, after that, that's when we now have our what we call operating profits. Now, some people usually say, But EBITDA is supposed to be the operating profit. Why we having depreciation and amortization? As I said, every business, they all have their business cycle. So we believe that assets, there's no way business will not have assets. It's those assets that you are using to generate revenue. Another question that comes into play is, but what about consultants, guys? Right? It's not as if they have plant and equipment. But yes, that's the asset of almost every consulting firm. In fact, there's this school of thought that are saying we should find a way which we can actually value some personnel and give them value, maybe intangible, make them intangible assets in the balance sheet. When the next question is, does it meet our asset definition? Right? Our asset is saying you must have a control on any assets. You don't have control on any human being. They can decide to come tomorrow and tell you they are not working again. So they're like, that school of thought, they're like, no, that cannot work. Okay, another one that came, okay, if that cannot work, those kind of salary that will pay those top personnel, right? There are some companies, if some personnel kind of leave the company, it will affect the company as a whole. Because as they are going with their clients, they are going with their resources. Okay, there should be a way to put it under cost of sales. Then the next question, how do we value it? Those salary. So the story is just kind of just decide that, you know what, let's just put them under their normal salary. Right? So maybe one of the other day we can take a look at them. So then we have our operating profit. So that's why operating profits kind of come into play. Yes, there's time for questions. So just be putting your question down. So we have our operating profits. We believe you have some asset that you're using to generate more revenue. So remember our sales turnover ratio. Yes, that's what that guy is releasing. Then other income come into play. If the other income has nothing to do with the business core operations, right? It should be separate. Finance income, finance cost comes into play. These three guys deals with management decision, which means how well are you managing your financing? Let's assume Nestle is using more of loans and Unilever is using more of equity and they have less debt. Right? So definitely, you know that Nestle we have more interest expense. Should that be the basis? Is their respective decision. Investing, which kind of gives rise to our other income, from finance income, definitely it is their own decision. It is management decision. But you can decide not to even use any loans. Yes, I think I have one company in Nigeria like that they don't use loan. It's funny. It's the management decision, and that should not affect our comparison. Then we have our profit before tax. Then tax expense, government will come into play to take their own. Now, government and tax, a lot of story around that. Yes. We usually have what we call corporate tax rates. But if you check most corporate organizations, if you check their tax expense to their profit before tax, you see that you will not get the same thing. There are a lot of story around that. So we are saying that should not be the basis when we are comparing A to A. And if you see, from we finance guys, in fact, we just pick whenever we are doing our analysis. So remember, we have our free cash flow to the firm, which is more important to us, right? To the accountant, yes, cash flow statement. But we are saying, oh, this free cash flow. So this is what we use to actually see the real cash. And then we have our profits after tax. Then from our SG&A down to our profit for the year, we said those are the top line. From our depreciation down to our tax expense, we said they deal with management decision. I hope you enjoy it. I hope you are picking one or two things from this. Now, let's remind ourselves of bad drivers in financial modeling. Financial modeling is all about drivers. Yes, I want to forecast the line item. What can drive it? So when you hear driver, it's basically saying, what are the components that I can use as a basis to forecast this line item? So let me run us through this before we jump into the practical case study to see how we restructured our income statements. Here we have our revenue. And when we say drivers, basically you are saying it's still the same thing as the accounting. Yes. So if you want to do your revenue, definitely you know what will be the price, what's the unit that they've sold, and all those things. But saying, okay, going forward and you want to do that forecast, what can you use? Yes, at times if you are dealing with corporate organization, yes, you can still do a work back to get their price, their quantity, right? Get their capacity. For a startup, definitely you must get this. What is their price, quantity, and capacity? But if you are dealing with a corporate organization, whereas all the information about the company is what you can only get from the annual report. That's where we use what we call growth rates. Oh, the revenue will grow by this also percentage. So competitions, those are the different things that can drive and can affect a business revenue. Demand, go straight to go, you kind of analyze what's happening in the market. How do you think this business will perform in the coming year? Okay, oh, the revenue will grow by this also percentage. You can break down the price, the quantity. Great, you can go ahead and do that as an element. So our cost of sales, right? You're asking, oh, what can I use as a driver? I want to focus my cost of sales. So for we modelers, we usually think from the perspective of output. If I'm building a financial model, I know that definitely my 3 outputs, it will be my income statement, balance sheets, and my cash flow statement. Then every other thing I'm doing, they're just picking their variable from these 3 financial statements. I want to do ratio, margin analysis, valuation, NPV, everything I'm picking their variable from these 3 guys. So you are now asking, oh, if I want to forecast for this business, definitely I need my 3 financial statements. And I'm asking, oh, guys, how will you be generating your revenue? What do I need? Oh, if you are breaking things down, what will be your price? What will be your quantity? What will be your customers? What will be the growth? You go to your cost of sales, you're asking, oh, what are the cost per unit? What will be the effects increasing because of time value of money, inflation, right? If it's difficult to break things down, if it's difficult to break things down, that's when we now use it as a drive as a percent to our revenue, because we believe that anything that happens to revenue, cost of sales should be affected, right? So you're saying, so for me to do my forecast, what can I use as a basis? SG&A, you go ahead and you are asking, oh, this business, if I cannot break down the SG&A, I can set it as a percentage of revenue. As I said, revenue is like the umbrella, and almost every line item can be driven by revenue. Cost, oh, time value of money. If you can break it down, what will be their monthly expenses? All those, yes, it's very easy. You can go ahead and do that. You go ahead, depreciation. What is my driver? What is driving it? Depreciation definitely is when you have assets, your PPE, you have your fixed assets, the time, right? You are not using time, you are using rates. You go ahead, finance costs. Oh, this business, are you making use of? Are you going to make use of loan? Do you have overdraft rates? Do you have cash that you are going to invest? You just asking those questions for me to forecast this line item. What are the things that I need? For my tax cost, you're saying, oh, what will be your profit before tax? What will be the rates? Yes, I know some of us we have questions, so don't worry, just be writing it somewhere. We're going to have a question time. Now let's get straight into the case study of restructuring. And as I said, we are going to make use of this our Dangote cement as an example. So we want to restructure this. Now, when we talk about restructuring, always keep this at the back of your mind. We are not auditing what the auditors have done. No. And we are not questioning what they've done. But for us to be able to have insights, number 1, to be able to compare likes to likes, number 2, to have the necessary metrics needed, number 3, and also number 4, to be sure that yes, each line item, they all have a clean and clear driver. As I said, definitely at times it will not be easy for us to break down cost of sales into what is the cost of the unit, right? So we're not saying, okay, what will be the closest driver? As we said, revenue is like the umbrella. So we are saying, oh, our cost of sale is a percent of our revenue. We want to be sure that yes, almost everything that we assume the auditor or accountant they've put under cost of sales can really be driven by revenue, such that if something happens to revenue, yes, it will affect that line item, either directly or indirectly. So what I'm going to do now is I'm going to open a blank Excel. So let me open a blank Excel. Yes, as you can see on my screen. And what do we want to do? I'm going to copy this our financial statement. I'm going to copy it into my Excel so I can work smart. Now, something about Excel, if I copy it like this, right? Let's work with the group 2020 and 2019. So if I highlight everything like this, I press my Control C, go straight to my Excel, and let me even come here and I press my Control V. Look at what happened. This is not what we want, right? This is not what we want. Okay, so for some of us that we are saying we don't have audio, I think okay, please, Mike, maybe just try and help us send them a direct message. They should try and rejoin. Yes. So you see what we have now. This is not what this really not. I cannot be wasting my time and be doing this one after the other. So in fact, let me make this good. So let me collapse this 3 line and let me call this our period. So I'm going to call this, let's call this 2019, and this will be 2020. Right? Let me expand this, guys, and let's call this our description. So I like formatting my stuff whenever I'm working. Let me shift this guy here. So let me put this. Let me call this our unit. All right. So to go back now, I want to copy this. Now, I'm going to use a trick to copy from my PDF to my Excel. Now you can only do this, number one, if you are using Adobe Acrobat Reader. And secondly, if the financial statement is not a scanned financial statement. Yes. I'll come to this, my revenue. So which means I want to copy columns by columns. I'll come close to my revenue. So I'll make sure I select this, my 2, right? This is my selection 2. I'll make sure I select this one. So we have 2 selection 2. One is and, then the other one is this, our arrow. Then I'll bring it close to where I have my revenue, where we have this R, and the icon will change to a straight line. I'll click Alt on my keyboard and my left mouse. Then 1 square bracket will be displayed around it. Then I will use my mouse to just drag down. So I need from my revenue down to my profit for the year. Remove my hand from my keyboard, press my Control C, go back to my Excel, come down here, and I'll press it, Control V. So let me copy my financials for 2019 as well. So for the accountants, we usually have our current period by our left, while previous year by our right. But for our finance, is the other way around. We usually have our current year by our right and previous year by your right. So for 2020, okay, let's copy 2019 first. I will do the same thing. Come close to where I have my hits, press my Alt, my left mouse, then just drag down through the column. Remove my hand, press my Control C, come back to my Excel and press my Control V. Go back, do the same thing for this. Just highlight everything. Copy, then I'll paste that here. Okay, so I've done one mistake, right? So let me put this back. Yeah, so let me adjust that. Okay. Now we have this. So let's kind of building up our special line, our total line item.
Sorry, please, can you rephrase a bit the copy and paste side?
Don't worry, you have access to the recording, so you can always go through that. Don't worry. Yes, don't worry, it's a trick. Yes. Okay. So in fact, most times when I'm working, I don't like saying this borderline. Yes, so let me just remove that. So I like it to just look like this. So let's call this, let me rename this worksheet to our extract. So these are our income statements. Income statements. So let's call it per audit. Per audits, yes. So we know that. Let me put this in one style like that. Okay, good. Okay, can copy this same style. Let me put it down here, and let's do our analysis. So analysis, let me put it as accounting. So a typical accounting analysis. Number one, something we can get. We'll say we need our revenue growth, right? Then we'll say, oh, let's look at our cost of sales margin. Sales margin. Then what's our gross profit margin? I hope you can see my screen. I should zoom out. So we can need our gross profit margin. Which other thing? Let's say we want to look at our SG&A, to our revenue, right? how well are we managing our that? Then we'll see our profit, our operating margin. Then which other one can we have? Which other one? We can have our profit before tax margin. Then we can have our what? Our net profit margin. So I think everything here, we have them in, they are in millions. Let's be sure. Okay, yes, Naira million. So NGN, so put it in million. So this is always good to always do this whenever we are building any model. So let me put it here so that the guy kind of look good. Okay. Then here, all these ones will just be percentage. And let's do the normal typical calculations for an accountant. So for me to get my revenue growth here, I think I'll need to get my revenue for 2018. Let me see where we can get that. Every company usually have their 5 years summary. So let's see it here. Let's see it. Let me scroll for us to see that 5 years financial so that we can pick that revenue. Okay. There are 5 years financial summary. Is all we need. Where is it? Okay, I think we are getting close. 5 years summary. Okay, for the group. Okay, right. So what's the revenue for 2018? So 2018 revenue. This is the revenue for 2018. I can just copy this. I'll come and put it here. Okay, so that we can have our revenue growth for 2 periods. In fact, all these guys, let me just put them in percentage so that we can work very fast. Now, revenue growth, which is current year divided by my previous year minus 1. Enter to the right, Control R. My cost of sales margin, let me say this is my cost of sales. So now, before we do that, according to our fast standard, right? Our fast standard is saying whenever you are building your model should not contain negative values. Right? We have some companies policy that say no, anything you are doing anything and is in negative, you are deducting it, put it in negative. Yes. In fact, our standards, yes. In fact, my country, that's what they do. But I think GAP don't usually put whatever thing they are deducting in negative. For example, this is our production cost of sale that they put in brackets. They just put it in the absolute value. So also our first standard that we use in building our financial model is also saying whenever you are building your model, right? Your model should never contain a negative value, except for number 1, your net loss, which is definitely a calculation result in your profit or loss accounts, cash that is going out in your cash flow statement, retain losses in your balance sheet, and a change, which is more like a reduction, right? Those ones are allowed to be negative, but every other thing, always try and put it as the absolute value. Then you go ahead in your formulas. That's when you can do this minus this. So what we're going to do is I'm going to remove all these guys. I'll just highlight everything, press my Control H. What am I looking for? I'm looking for minus. I'll just type my minus. Under replace with nothing, and I'll click on replace all. Click on my OK. So we have everything in their absolute value. So cost of sales equal to, that will be my cost of sales divided by my what? My revenue. Enter to the right. My gross profit margin, gross profit divided by my, okay. So I'll do that again. So that will be our gross profit divided by what? Our revenue. Enter. Our SG&A, so our sales. So I think that will be our admin plus our selling and distribution, then divided by our what? Our revenue. Enter. To the right. Operating margin, that will be our what? Profit from our operating activities divided by my revenue. Enter to the right. Then our profit before tax margin, this divided by what? Our revenue. Enter this. Net profit margin, this divided by our what? Our revenue. Then I have this. Now you can do this, and that the other school of thought is now saying, okay, after we've measured this, you can also measure how this company, they are managing this guy called gross profit to cover up this as well, for you to kind of understand how well is this company managing themselves. Now, taking a look at this, looks like this company kind of have a good trend. So revenue, yes, we know revenue can always change, but how well are they adjusting their costs to have a good profitability stand? In 20, so let me freeze this panel so that we have the year showing up here. So in 2019, their cost of sales 42.6, right? Despite revenue kind of reduced. In 2020, despite them having a significant increase, they still try and maintain that same margin. Gross profit, you can see they maintain the same margin. SG&A, something kind of happened. 2019, when revenue was a little bit small, right? 24%. Then they increased their revenue in 2020 and they try to cut down their cost. That's really a good thing, right? Operating margin increased in 2020. Profit before tax margin increased and net profit margin also increased. This is for we accountants. But you now know what? To we finance guys, which will be the next thing we are going to do. So in fact, let me duplicate this. Let me just duplicate this worksheet and let's call this our restructure. Let's call this our restructure. So this is our other analysis for now. I don't need it. Let me delete this. Remember, what we want to do now is want to take a look at how can we restructure this? How do we restructure this? Based on that structure that we took a look at, right? I hope you still remember that. Let me show us. Let me take my slide back so that we still remember that this is the structure that we want. Revenue, cost of sales, gross profit, SG&A, EBITDA, depreciation, amortization, operating, right? Other income, finance income. This is how we want it to be, to give room for comparison. And we can see the true profit that the business is really making from their core business operation. But currently now it's looking different from what we have. So the next thing is we need to restructure it. As I said, we are not changing auditors' figures. No, that's not our own objective. It's not to change it, but for us to be able to achieve our own objective based on this structure. Now, before we even do that, a colleague of mine, while he was trying to restructure this kind of thing, he spent like 5 hours on it. Trust me, I'm quite sure we don't have 5 hours to spend today. So before you start doing that, it's always good, as you said, irrespective of anything you do, you are not changing auditors' figures. You see, this profit for the year must always be the same thing. You are never going to change that. So to keep touch of that, I'm going to write my net profit per audit. Remember, we are not changing auditors' value. That's not the objective. So I'll copy this, my net profits. I'll paste it here. So that irrespective of anything I do to these financials, this profit per audit must be the same thing. Then I'll build a reconcile to. Yeah. But let's call it recon to. And this recon to will help me to keep track so that I don't waste much time. So whenever I'm doing any mistake, maybe I mistakenly enter the wrong value. Yes, it will call my attention to that. And I'll use my if function equal to if my net profit per audit that I've pasted up here. Remember, I paste this as value, not as formula, as values. Equal to if my net profit per audit that I have up here is the same thing with my profit for the year that I have down here. Comma, open my quote, Excel should give me okay, close my quotes. If not, my net profit per audit minus my profit for the year. Close the bracket and press enter. So it's giving me okay to the right. So currently now, if I delete anything, the reconcile tool is not working yet. So which means I need to go ahead, everything here, you can see that they are all value, there's no formula. Then I need to now go ahead and put the appropriate formula. For example, my gross profit will be equal to revenue minus my production cost of sales. Enter. To the right, Control R. You see, it's still the same value. Come here. In fact, I can even copy this guy. Let me copy it by the side so that I'm sure that it's the same thing by the time I'm putting the formula. So I'll come down here, type my equal to gross profit minus admin expenses minus SG&A, right? Plus other income, impairment of financial assets supposed to be deducted, right? Minus this and press enter. So currently now it's not giving me the same thing. So which means this, their impairments, I think this was a reverser. So they added back this impairments, part of those story that usually why you see you need to restructure that. If I copy this to the right, this for the following year, it was deducted. You see that? So I just said I should show us that. Okay. Then let me come here. Profit before tax should be equal to my operating profit plus my finance income minus my finance cost plus my share of profit for the year. Drag to the right. My profit for the year should be equal to my profit before tax minus income tax to the right, and I have that. So such that if I go ahead and let me delete my SG and A, see what my reconcile should show. Right? You can see this. You can see this. Someone is saying, is mapping each line a quick option? Right? For instance, map the rough spool, create a mirror. No. So okay, all right. I understand that. So we are just trying to. This is like a from our 100% that we have. I just want to show you like 5% from it. Yes, we have a standard that also governs when you are building corporate project finance, corporate finance or project finance, and also if you are restructuring, there's also a policy for that. Everything should always be in their values. Yes, no formulas, especially only for the line item. Okay, so now we have this. Remember our structure. This is the structure that we want. We need EBITDA, depreciation, amortization. This should come down. Now let's take it step by step. In fact, let me bring this down. Let's call this our SG and A, which will be the summation of these two guys, right? So let me reduce this column a little bit so that we remember. That these two guys, this is what they are. So we need that line item, and we said below this is where our EBITDA should come to. EBITDA should come in here. Then after that, we said our depreciation and our amortization should come in here. So now, let's check the financials. When we said modeling is all about driver, and part of the reason why we are saying, yes, restructuring is good. Yes, you can build a corporate model without restructuring. It depends on the objective. If you want to forecast your production cost of sales, as I said, at times it's difficult for you to break things down. And as such, you can use it as a driver. So if I want to forecast my production cost of sales, I can ask, my historical period, what is their cost of sales margin, right? So if someone wants to build a model, you can just type this 379 divided by their revenue and take a look at their margin for the historical period. This is around 42.2, right? So going forward, you can just decide to use your 42.5 to do their forecast. Yes, you can be right. But the next question, we need to take a step back. Remember, we said we are saying all the line items must have a very clean driver. So we are saying, if you're saying my cost of sale is a percent of my revenue, right? That there's a driver. We are saying all the line items in our production cost of sales should all have this connection with revenue, such that if anything happens to revenue, it will affect that line item. Now, for us to get that, we need to go and take a look at the notes to be sure. Let me put this back. So I think that should be page 159. We are going to take a look at the notes to the account. Production cost of sales, that is note 7. So let me scroll down to note 7. Where is note 7? Note 7, note 7, note 7. So let's check note 7, note 7, note 7, 7. Okay, so I'll pass through that. Note 6, note 7, yes. Now, but let me zoom this out. And let's have a discussion around this. We are saying this line item, our cost of sales, is a driver, is a percent of our revenue. We are saying anything that happens to revenue will also affect this guy directly or indirectly, which means there's a relationship. Now, material consumed. Do you think it can be driven by revenue such that if anything happens to revenue, right? Which means if you are selling 100 units, your material cost should also be to that 100 units. If you are selling 20 units, if you are producing 20 units, definitely your material cost is supposed to reduce as well. Can we assume that, okay, yes, material consumed can be set as a driver to our revenue, right? Let me hear from us. Just type yes in the chat box. Yeah, it's kind of have this relationship with revenue. Thank you. Fuel and power consumed. So let's assume fuel and power consumed are related to the factory plants that they use in producing that material. So let's assume, okay, yes, that can also be there. Royalty, they say royalty payable is charged based on volume of extraction during the year. Okay, maybe they're using natural resources and they are paying royalty on it, so such that if they don't incur that, they don't pay the royalty, they might not allow them to extract. So definitely that is attached to it. Salaries and related costs. Definitely we have some overhead, right? Those labor guys, those guys that work in the factory, that will pay them per hours. So if you do this, we'll pay you this. Definitely it's kind of attached to it, right? So we're saying, no, if you are producing 100, which means this is how you need to spend on it, and that's the amount we are going to pay you. So let's assume that. Now, depreciation and amortization. What do you think about that? Do you think it is affected by our revenue? Such that if revenue, what that means is we are saying if revenue decrease, depreciation is supposed to decrease. If revenue increase, right? If you are producing 20 units, yes, depreciation is supposed to also increase. What do you think about that? Do you think depreciation and amortization, based on this driver, that understanding, do you think it kind of fits into this? So the real question is this. It is no. Yes, I know, yes, those depreciation are charged on our factory plants and all the stuff. But the way we calculate our depreciation, we say, no, you are buying this asset, so the lifespan is 5 years. So irrespective either revenue increase or decrease, depreciation is going on. So which means if you are now saying, my cost of sales is a percent of my revenue, automatically there is a dirty line item there. And remember what we said, for comparison's sake, depreciation use of assets supposed to be below our EBITDA so that we can see the true color and give room for that comparison. Even to we accountants, right? Even if you are not selling, right, you'll still be charging that depreciation. And that's what kind of gives rise to this, our revaluation, all those things. But we're not going there today. We're not going there today. So which means depreciation kind of look different. Plant maintenance, yes, all those factory plants that they are using. Other production expenses, we can assume. Remember, we are not auditing them. Decrease in finished goods and work in progress, yes, that is also their stuff. So which means this depreciation that they've charged to their production cost of sales, in fact, luckily, Dangote is a good example. There are some companies that they will not give you like this. You need to go to their asset schedule and I'll be asking this asset, let's say maybe they have plant and machinery, you are now asking the depreciation that they've charged on that, where are you taking it from? Furniture and fitting, where are you picking that depreciation from? Right? So for this one, depreciation, which means we are going to deduct this value from our cost of sales so that we can have a clean cost of sales, that we know that yes, all this line item, they are the real cost of sales. And if anything happens to our revenue, it will affect all this line item. And that's why it is easy for us to say, oh, going forward, I want to forecast my own cost of sales, I can just set this as percent of my revenue. So I'm going to copy this for 2019, 6525, let me copy that. I'll come to my Excel based on our corporate standard of building corporate model. It's saying whenever you are doing any adjustment to any auditor's line item, number one, make sure you hard code everything. Always put is equal to in front of it like this. Put is equal to. Then what are we deducting? So this one, I'll just type my minus, then I'll paste the value that I copied. And I'll press my enter. The one for the second year, which is 2020, I can also copy this. Come here. Equal to minus, then I'll put this as well. Enter. So which means this is the true, to we analysts, to a modeler, this is the true cost of sales. Because we assume that yes, every line item in here can be driven and be affected by revenue, such that now if you take a look at the trend going forward, you can say, oh, my production cost of sales is what is percent of my revenue. And it is easy going forward, you ensure that yes, my driver is clean. Now, something we've deducted from here, as I said, one of the best practice, you now put comments. Now let's look. So we now put comments. My shift F2 to put comments. Put comments, right? Most time when you are building corporate model, you are doing this restructuring. It's when you are working on it that you remember. When you are done, you might have forgotten. And also, saying our standard is saying your model must be flexible, transparent, such that someone else can pick the model and understand what you've done. So this, I'll just type my I'm looking for the right word to, okay, so let's say reclassified. Did we reclassify it? Okay, let's call it backed out depreciation from our cost of goods, our cost of sales, right? Then the next thing is I'm going to put the note, that is note 7, right? And page what? I'll put the page number. That's page 186, page 186. This is part of a corporate practice, right? Such that when you build a model, even if you yourself, you are picking it up, you send it to your colleague, they can always work with the model and understand what you've done and how you've done it. Now, what we've deducted from here, remember we said, irrespective of anything we are doing, this profit for the period must remain the same, right? So which means what we've deducted here, what are we doing to it? We've created a separate line item here called EBITDA. So which means we are going to bring that here. Remember, follow the best practice, equal to, I'm going to type with 65254, enter, come here, equal to 64946. Okay, 64946, and I'll press my enter. In fact, let's even put our formula very well. So for this, our SG&A, let me call this, that will be our admin plus our selling and general admin expenses, right? Then for our EBITDA will then be our what? Our gross profit minus our what? SG&A. So we just added, so you can decide to merge these two together, but let's just put it like this. Then my operating profit, let me just put that formula again, equal to my EBITDA minus my depreciation minus my amortization plus my other income. Then I think this one, I said just added back plus this, enter. So you see my reconcile to which throw back, okay, which means what I've deducted from here, what am I going to do with it? And for this one, I'm saying this will be minus. So we have this. Okay, so now we've done the first one. So we show that, yes, our depreciation, this is our clean cost of sale. The next one is our SG&A, our admin, right, expenses. So I'll come in here. I think admin is note 8. Now, for this administrative expenses, don't waste your time trying to break those line items down. There's no way you break it down that you will get it. In fact, this company financials is still straightforward. There are some, they will just give you cost by nature, and they will just add everything together. Then you now be the one to be looking for, okay, go to the asset schedule and you ask me, oh, these assets, where do you think they would have deducted it from? Do you think they would have charged the depreciation to this cost of sale or to their what? SG&A. So here, all this line item, yes, everything can be affected by revenue. That's the truth. So remember, we are not digging deep. We are not questioning what auditors have done. We just take a look at, oh, this line item, you can see here, depreciation and amortization. What is the driver? Definitely it's our PPE. It has nothing to do with revenue. It is, oh, you have assets, more assets you have, then more. So it's related to that. So without wasting our time, we just pick this depreciation that we have here. So this is on admin expenses. Let me also copy it. Come here to my admin, right? For 2019, the same thing, equal to minus, I'll deduct it from here. Enter. And let me put my notes again, my shift F2, put my comments, backed out depreciation. I think that's notes 8, page, I think, what's the page? The page is what? So these are, this is part of the best practice, right? Page 186. In fact, it will also help you because most times you have a lot to do and you would have even forgotten what you've done. Then for the second period, this 2020, let me copy this 6235, put it here. Remember, type my equal to, then minus, paste the value. And we have this. So what I've deducted, where am I taking it to? Definitely it's going to the depreciation line item. So plus 6359, enter, and to this guy, plus 6235, and I press my enter. The next one is our what? Our, okay, we've seen our admin expenses. Which other one? So these are selling, general, and admin expenses. So it's okay. I think I saw something now from what is Just okay. So this, they call this depreciation and amortization. So maybe we should just put two of them together, right? So we call it depreciation instead of separating it, since they did not separate it in their own. Amortization. Okay, so just put it together. Then let's look at our next one, which is our selling, general and admin, our selling and distribution expenses. This is the depreciation that they charge to it. So I'll just copy this guy also. Copy, come in here, right? Type my, okay, this should be for 2019, equal to minus what I'm deducting. Now press my enter. Go straight to the second one. Depreciation for the 2020, copy it, come in here, deduct it as well, minus, and paste this, and press my enter. Now what I've deducted, so let's just delete this amortization since we are putting both of them together. Okay, so this guy, because of what I've deleted, let me remove this. So what we've deducted here, so that I can work fast. Okay, so I think let me go back to what I deleted so that this will not mess things up. Let's take it step by step. What do we delete here? Okay. I think this is what I'm supposed to delete. And here, this is what I'm supposed to delete as well. So these are the funny mistakes you can also make, and you need to be what? To take note of it. So what I deducted from here, which is our 2385, I'll come here to my depreciation and I'm adding it here so that we know that yes, anything related to depreciation, we have it in our depreciation line item. So I'm just trying to work very fast. Now come here, minus, and you have it. Okay, so what's this? Okay, this should be plus. Then we have this. Now we said our other income should be below our what? Our EBIT. So which means this other income that they've put here, I'm going to back it out. But before we do that, remember, it is always good for us to check the note to the account to be sure that this other income, are we sure it has nothing to do with the main core business operations? Right? I've seen a company like that, that their core business operation is, their other income is actually part of their core business operation. Yes. So let's check. Other income, note 11. Okay. Let me try, I think 186 so that we can see that. Other income. So these are part of what you need to go through whenever you are restructuring financials. So other income, note 11. Okay, so other income, insurance claims. This company, they sell cement. Government grant, they sell cement. Sundry income, this company sells cement. I've seen a company that the EBITDA was a negative loss, right? Loss is loss, right? Yeah, loss, but they had a good profitability stand. Now, for an investor, if you want to invest in that kind of business and you pick only the net profits, trust me, something is off, because the core business operation is really not generating any revenue. They are depending on other income, and anything can happen to other income. So for us to have a clean, right comparison, this other income, what we are going to do is we are going to bring it, back it out, and we'll bring it under our profits. But let's call this our EBIT, right? Or I will call it our operating profit. Operating profits. Right? So we bring this other income, but for now, let me copy it. Let me just copy it and let me put it here. Then I'm going to delete it. So before I delete it, let me, okay, so the formula does not scatter. Right? So when you are doing this restructuring, you really need to be very, very careful so that you don't waste much time on this. So this, let me just delete our ref, guys. Okay, so let me do this again for this second one. Enter. So part of why you need this reconcile to always keep us track. Yes, so don't worry. As I said, we are going to share the recording with us. Yes, we're also looking at time as well. And remember, this is just a snapshot of what we have. So I can now go ahead, adjust this formula, and include my what? Include my other income here, and press my enter. So now you see that this is now looking like what we want. EBITDA, depreciation, amortization, operating profits, other income. Now, because of time, right? This is what we are going to do. We are going to share the recording of this with us. We are not yet done with the restructuring, because you see this finance income, finance costs. You also need to restructure it. Now, when you hear anything like, when you are dealing with restructuring, most times it's always good to work with basic knowledge and understanding of accounting. So when you hear interest income, what comes to your mind? Definitely a basic interest income calculation is your what? Maybe your investment, your cash deposit, then multiply by the respective rate, right? So that means if you want to go ahead and build your own model for your own forecast, you can take their cash, assume they will deposit it, and multiply by the current deposit rate, right? Or look at the trend of their interest income for the forecast period and use that as a basis. For the finance cost, interest expense, right? You say, no, what is their financial liabilities, loan, overdraft, right? If they have some leases, right? You multiply by the respective rate. But you need to now go and check the notes. Are you sure this is what they've done? So we're not going to, okay, yes.
Sorry to bother you. We are out of time. We are running out of time.
Exactly, yes. I'm just trying to round up. Yes. Sorry about that. Okay, so you go and check their the notes to the account for their finance income and finance cost. For example, now see the finance income. They have interest income and other foreign exchange gain. Two of them, they are different drivers. Interest income, we said maybe their investments or their cash deposit and the rate. Foreign exchange, definitely that is driven by foreign our FX rates. That's nothing to do with that. So those are the kind of things that you need to check out before you even start building your model. And with this, you can now go ahead, do that analysis. This analysis that we did, that we call accounting own, you now need to redo it and now see the difference. In fact, you'll be able to see the clean trend and how well the business is managing and adjusting themselves. So a big thanks to our sponsor. I'm going to hand over to them now. So in case you have any question, I'll still be here. So my boss, let me just hand over to sorry, I have to take additional time. Yes, this thing is kind of vast. As I said, we're just giving you like 5% of 100% of what we have.
Thank you, Victor. So I think we can take questions without wasting too much of the time. Maybe the next 5 minutes we take a question, then in another 10 minutes we can just quickly share a bit of information with you. So we can take questions now. If you have any questions, please, you can raise your hand, use the hand raising option, and will allow you to speak.
Okay, I feel maybe we should talk about that information first, then we now kind of wrap things up with the questions so that we'll be able to save a lot of time.
Okay, all right, then. That's
so
fine.
let me just stop my screen sharing. Right?
Okay. Yes, so just so I'm just going to share my screen now. Just a second. Okay, thank you, Victor. Thank you, everyone, for your time. Please let me know once you can see my screen. Are you able to see my screen?
Yeah, we can see it.
We can see, but we are seeing the, okay, yes, we can see it.
Okay, so this is just a short message, and I have decided to title Leveraging Industry Expert Experience to Settle it. And the reason why you should choose Senior Academy. So this is just to show you a bit of what we are putting together for people who want to really take it take it further from where we have stopped today. So the Scenario Academy decided to introduce a program in addition to our existing program called the Financial Modeling and Business Valuation for people who take our Excel courses. We're asking for an advanced program, and it turns out that most of them actually are from the financial services industry. So, which is one of the major drivers of this program, of this initiative. So we have a program we have put together called the Financial Modeling and Business Valuation for Corporate and Startups, meaning that while we are building different models or trying to understand business valuation, we will be talking from both the aspect of a corporate perspective and also startups perspective. So this is the program we have introduced. It's called Financial Modeling and Business Valuation with Microsoft Excel. As you can see, the outline will be looking at a component of revenue and cost, then move ahead to advanced accounting and finance concepts, model drivers and financial information, model build toolkit and forecasting factor, financial statement restructuring and advanced analysis, taking it beyond what Victor has highlighted, model input and forecasting methods, three statement corporate model build, investment evaluation, ratios and valuation, as well as business valuation. So this program is starting on the 9th of October, which is up past Saturday. And it's going to run for 5 weeks, Saturday and Sunday, 5 p.m. to 7 p.m. So if you are interested in enrolling for this, please remember that the prerequisite to taking this program is having an interest and little understanding about the finance concept, accounting, as well as at least maybe an intermediate knowledge of Microsoft Excel. So that's the requirement or prerequisite for it. If you want to register for it, you can go to our website. The fee is $70,000 or $150. So you have the option to pay either in Naira or in dollars on our website. So, but if you feel that you are not yet there as far as Excel is concerned, you can also, decide to start from the basics, which is having to join our data analytics class with Excel, SQL, and Power BI. So these are the details and the pricing. And the next start date for our data analytics class is for the online class is the 2nd of October 2021, which is next Saturday. Then physical class, if you prefer physical class, then it's starting on the 30th of October, which is the ending of next month. So we take you from the beginners to advanced to the intermediate to advanced concept in Microsoft Excel, SQL, and Power BI. So and also we also have the data science program as well. Regarding our approach in terms of training, please remember that the financial modeling program is only an online class at the moment, so anybody can join from anywhere. But in terms of our training learning approach, it's a kind of mentored learning approach that we have designed such that you're taking more like a mentee rather than just a participant or a student. So our class design is both instructor-led and student-led, meaning that there are examples and there are exercises that have to be done within the space of the lecture or each session. Class recordings are made available immediately after the class. We work on real-life application, solving real-life problems, taking real-life exercises. And also our participants are quite diverse, so it helps you to really network, expose you to opportunities and the likes. Then also our instructors are also available and accessible 24/7. Should you have any challenges, issue, or questions or concerns. And also the key part is the capstone project. Usually takes or requires a bit of commitment, dedication, and diligence to finish up the capstone project. Other benefit is the executive or data-driven strategy and data-driven decision-making session that help you to look at some bit of advanced initiative-driven analytics that can actually drive initiative within an organization. Of course, the end goal is actually to either improve revenue or to, improve the operations within the organization. So organizations are quite moving from intuition or the traditional intuition-based decision-making to insight-driven decision-making right now. Alumni, I mentioned earlier, I added to a group of our alumni. We meet quarterly to bring experts who can share knowledge with you, trends, and every other thing. In terms of one of the other things we get to do is to really expose you to what the business expectations are from you in case you eventually transition to a new role, either as an expert financial modeler or data analytics or decision analyst. We help you to understand what are business expectations from you, what should be your expectation from the business as well. We help you understand some of the advanced concepts in analytics as looking at the concept of, new and repeated customer, how are they faring, what should you be targeting, and the likes. And a lot of insight comes out from there where you understand how some businessmen within maybe Alaba seems to have more interest in education insurance than even the learned ones. So there are a lot of insight that are drawn and we help you to understand Pareto 80-20, how it's being used in business and how it influences decision making. Basket analysis, how you can drive initiative from there to really tackle an expected business decline within a certain period. Sensitivity analysis, a host of advanced concepts will help you to understand. So that's just a brief of what we do and what we have in the offering for us. So I think right now, myself and most importantly, Victor would take your questions should you have any. So I will also be reading the chat in case you have questions in the chat for us, for either Victor or myself. Please note that the recordings will be made of this session will also be made available and sent to you. So please, you can ask your question if you have any. Okay, Samuel, please, you raised your hand, please. Samuel, go ahead, please.
Unmute yourself, Samuel.
Hello, Samuel. Okay, let's take while Mark.
Yes. Yes. Hello, everybody. Thank you. First, I would like to thank Victor for this impressive explanation. I'm just checking if we can during for the timing of the sessions, if it's possible to start the Sunday sessions 1 hour earlier. I'm not sure if this will be suitable for all, but I'm just checking because I have like another session. It's like it will be overlapping with me.
Yeah. Okay. So I think I'll just take that. So since we introduced the program, there have been a couple of interests from international people from outside of the country whose timing has been a bit that don't seem to be comfortable with the timing. So it's something that we are looking to and open to reviewing, but I cannot tell you if that we have made a decision about that for now. But it's something that we are currently reviewing, and we will communicate that with you, as soon as possible. hopefully before the ending of the week. But as it is, the timing still remains the same, but we are still looking at reviewing it. But even if we are ever going to review it, maybe an hour early or an hour later, based on the outcome of our decision. I hope that answers your question, Wael.
Yes, that's great. Thank you so much. I'll be waiting for the update. Yes.
No problem, no problem. Because I know that India is like 4 hours or 4 hours and a half ahead of us. So and there's been a couple of interests from that. So thank you. We'll get back to you. So we can take question from Daniel Mensah. I think Daniel raised his hand before T. Or okay. I don't know if Victor wanted to add anything to the answer because I saw you on mute.
Okay, no, you've actually answered it, and just to put this. This is just a one-time webinar that we're just trying to do. Yes, I think it was thinking maybe there's still another one tomorrow.
Oh, okay. Maybe I thought he was referring to the financial model and business valuation class that I currently have shared. So, but it's fine. All right, T, do you want to go now?
Yes, I would want to go. Thank you for the session. Very nice. I wanted to clarify who would be facilitating the financial modeling, this course, the financial modeling and business valuation. Who would be the tutor? Like,
so I think you can write an email to. I'm not sure I'm obliged to disclose that here, but you write an email to us. I'm sure they will definitely. I will definitely answer that. Our email is training.
I would like to know this. Okay, I'll send an email.
Or better still, you can just, if you go to our website, you see a platform, you see an option to chat, maybe WhatsApp chat to any of my colleagues, and they will attend to you and answer your question.
Okay.
All right then.
So are you saying, because I have more questions, are you implying that I should just go over there to ask?
No. Regarding that particular question, because I mentioned that I'm not obliged to disclose that. Okay. So regarding that particular question, you can just drop a message and you'll get a response. Or you can ask any other question that you have.
Okay. So I would also like to know the materials, the follow-up materials, in the sense that what are the documents that you would be giving to us?
Yeah, so once you register and you indicate your interest and commitment, all the material that you'll be needing for the program will be shared with you ahead.
Oh, okay. I would only know that once I register. I'm not privileged to know that.
In terms of, we can inform you about those materials, but in terms of giving you, we might not be able to give you. So regarding the content of the material, we'll definitely, if you can, I think you can also ask that, in a private chat with any of our members, then they will respond to you as well. So, okay. I mean, I cannot afford to go through all of it now because it will take a lot of our time. But I'm sure you get an answer to that question in private.
Okay, then my final question would be, is there going to be another session? So like, how many times in a year do you usually have this session?
Okay, so
if I'm not available for the next 5 weekends, like when will be the next batch?
Yeah, so usually it's always in 2 months interval before we have a new one. So if you start a session on the night, it will take another 2 months before we start another one.
Okay.
Yeah, and then also I'm not so sure about the possibility of that because we are moving into the December period as well. But you can always get more details on that.
Okay, so I'll just go onto your website and there's a chat box.
Yes, please. All right, thank you. Daniel, do you want to go now?
Yes, please. Thank you. Thank you very much, Victor, for such a great and insightful question. Session. Sorry. So I have one question for you. So when you are talking about the drivers of revenue, I just wanted to, know how can you be sure, of the accuracy of your revenue forecast for a startup. One of the participants, replied to my message when I posted it, but I also want to hear what you have to say about it.
Okay, all right. Thank you for that. A great question. Financial modeling for startup is a whole lot on its own, right? So but if you are doing the course, it's part of what they will definitely run us through. Then the other question is, how can you really validate the accuracy of your assumption for startups? So this is one thing I want us to know. Financial modeling is not a magic, right? The way you understand your accounting, right? We've run our business operation for this social period, and one guy will go in and do the recording and tell us, oh, this is our profit or loss account, this is our cash flow, this is our balance sheet. It's the same thing in financial modeling, but this time we're just looking into the future. So you're saying, okay, I'm selling this product. So it's realistic, it's practical, right? That's one thing I love about finance. You are saying, if I'm selling, okay, I want to be producing Nestle bottled water, and I'm saying, how much will it cost me to sell one bottle? Definitely you should be able to know if you have a good business strategy. Oh, I'll be selling this. Okay, maybe my competitor, or even if there's no competitor, how much, what is the value of this? I'll be selling it, let's say 100, put your own currency, right? Then the second thing is, how many units can I sell at a particular period? Oh, should be able to sell like maybe 500 units in a month, right? Then definitely to have your revenue, that is your price multiplied by your quantity. It's as simple as that. Then other constraint now comes into play, which you now need to apply. What is your company capacity? Right? That pricing that I'm saying I'm going to sell 100 naira. What if the next year, what will happen to that price? Oh, okay. Let's say inflation will come into play. Then our raw material that we use in producing this thing might increase, which might in turn affect our pricing. So how do we get to manage that? So financial modeling is not about values. It goes beyond just put something in Excel and say, hey, this my revenue will be 200. The next question is, what is the strategy behind it? So as a modeler, it's always good for you to know business plan in total. You might not be able to write it from A to Z, but you should be able to interpret and understand everything about business plan, business strategy, and that will really guide you. So when you're saying, oh, I'm going to sell 2,000 units in the next 3 years, what is the story behind it? Oh, we'll be incurring some expenses on our marketing. So definitely, you really cannot be 100% accurate. Yes, you are allowed to, so someone is questioning you this and that. You really cannot be accurate. You are not a magician. Nobody knows tomorrow. You only know that tomorrow is Sunday. That's the whole thing. So we're just trying to get some macroeconomic assumption, general assumption, to be able to be as accurate as we can be. But the truth is, we cannot be accurate. I hope I answer your question.
Yes, please. Thank you. Can I add a follow-up? Just a quick one. Yeah. So what if the business doesn't have a proper business plan? How can you be accurate with your quantity forecast?
Okay, great. So there's no way a business will operate on its own without a strategy, so when you hear something, we say, business, what's your business model? Definitely, because it's all about story. So if I'm saying, oh, I'm going to sell 300 units, definitely there should be a cost that will be attached to that. So I'm not just saying I'm going to units will increase. Definitely if unit is increasing, revenue is increasing, then my cost will be increasing. So there should be a relationship between your revenue and your costs to make each other, right? So kind of complement each other. It's not that revenue is growing on its own, yeah. Cost is just slow, right? So those are the things that you need to consider. Business model, irrespective of the kind of business you do, you must definitely have a business model. Yes, and that's why most of them don't usually last, because there's really no strategy, there's really no model. You just have values and they just think that will work.
Okay, thank you very much.
All right.
All right, thank you, David. Thank you, Daniel. Just to quickly add, I think I missed that out. We have a discount code on the screen right now. So you can use the code to enjoy a 12% discount on registration. Now, this discount code expires by noon Wednesday, 29th of September. So it's an opportunity for you because you are here today. You can take advantage of this by using the discount code to register. Yeah, so I have somebody else raised his hand right now. Do we have any more questions in the chat or in the from anybody on the call? Do we have any question? Please unmute your mic and ask your question if you have anyone.
Yeah, I have a question.
Yes, please go ahead.
This is Joshua Umukoro.
Go ahead, Joshua.
All right, an alumnus. So the 12%, is it the same for alumnus, or alumnus have a special discount above 12%?
I think we'll be fair enough with the discount. Yeah. We'll be fair enough with the discount. If anything changes for alumni, we'll definitely communicate that. But right now, that's the discount code applies to both alumni and anybody else on this call. So,
okay, all right.
So just bear with us.
All right, no problem. Thank you very much.
Just to address Courage. Courage asked a question. So you can make payment installment. So I think we accept 2 installments. Yes. So Wael, please go ahead.
Yeah, yes, just checking, asking about the way of payment outside Nigeria.
Yeah, so if you go to our website and you register for the course Financial Modeling online, you will see an option to pay in USD. So we have a payment partner called Flutterwave who is able to process payment within and outside of the country. So if you have further, challenge with that, you can always write to us by email. We'll definitely provide a means for you to make payment if the option we have online does not work for you.
Okay, great. Thank you so much.
All right, CJ, please go ahead. CJ, go ahead, please.
Hello, can you hear me?
Yes, we can.
Okay, just a quick thank you for Victor and also for this opportunity, Skinner Academy. I just have a quick question for Victor regarding the financial modeling. Like in terms of forecasting, how can you forecast, especially when you have like a free cash flow? How is it possible for you to forecast when you have a free cash flow?
Okay.
For example, the company has like maybe an unlevered free cash flow. How is it possible to have a forecast on that?
Okay, so let me try and get that correctly. When we talk about financial model, before you have a free cash flow, definitely you must have your 3 financial statements. Now, at times, yes, and it's only few. And before you can use that method, trust me, you must be in this high level, right? Because number one is all about your objective. So which means you don't have the 3 financial statements. You only have the company's free cash flow. And they're telling you, oh, use this free cash flow to value this business. Right? So the free cash flow, the next question is it historical or is it a forecasted one? Okay, if it is historical and they're asking you to forecast it, trust me, number one, it's actually not, it's not as if it's not a good method, but it's more like highest level of valuation, and only few experts that I know that are very good business valuation analysts that can do that. So if the company only supply you their free cash flow, ask them, what of your 3 financial statements? Because definitely they must have gotten that free cash flow from somewhere, right? Which is coming from that 3 financial statements. So it will always be good for you to ask, so that you see, remember our 3 financial statements, they are linked together. It's not as if one is independent of another. There's a flow. So you need to ask, right? I would really not advise that you only take free cash flow. Well, you can decide to work on their growth, use the growth method, but the reality of it is, as I said, it's more like highest level, and only few people can actually use it and still be accurate.
Okay, but can you also still use the what's it called? The standard cash flow method, like the DCF method?
Yeah, so as long as you have your free cash flow, right? You can do any analysis you want to do. You can go ahead and do your DCF, go ahead do your net present value, do your internal rate of return, do any type of analysis you want to do. Because free cash flow is, to we finance guys, still the same thing as your cash. That the accountant call their own cash flow. So you can always use it as an element to check any investment viability.
All right, thank you, Victor.
Yes, sir.
Yeah. Any other questions? Anybody else with questions before we round up or before we call it a day? Okay, so I think that, okay, Samson, please go ahead, Samson.
No questions, no questions.
All right.
I just enjoyed the session greatly.
All right, thank you, Samson. So I think in the absence of no question, Victor, is there any parting words, parting statement or comment before we call it a day?
All right, so a big thanks to Senior Academy. And trust me, if you're trying to kickstart your financial modeling and business valuation training, right, that kind of incorporates both corporate and startups, trust me, this is a very big one you need to jump on, right? 100%. Just like, as I said, this is just like a taste from what they kind of offer. And this fee, hey, in fact, when I was looking at the fee, I was like, seriously, are you for it? So it's rare that you get this kind of value for this kind of price. Trust me. So we just encourage us to jump on it as well. We keep learning every day. We keep learning. Yes. So thank you so much to Senior Academy, and thank you everyone for coming for this session.
Victor, we say a big thank you to you. With everybody who is on this call and who was on this call and maybe has dropped off, we want to say a big thank you to you too for taking your time out to join us. We sincerely appreciate your time. Without you, this wouldn't have been possible. We say thank you to everyone. Victor, we hope that when next we call, you definitely answer. Thank you so much, everyone. Thank you, Victor. Thank you, everyone. Have a wonderful day. Please remember the discount code expires on the 15th, on the 29th, which is Wednesday at 12 noon. The same discount code applies to any of our other programs apart from the financial modeling program. So thank you so much. God bless you. Yeah, the WhatsApp number is available 24 hours. Just to mention again, there's a possibility of instrumental payment. You can pay into installment. So that being said, I wish you all a wonderful weekend and enjoy the rest of today. God bless you all and a good day. Thank you. Have a wonderful night.
Thank you. Bye.
Thank you. Bye.
Thank you. Bye.
Bye, guys.
Bye.
Bye. Thank you.
Hello, my fellow Nigerians.